So let's get on into it and have some fun talking about cash value life insurance. You think that life insurance is boring? In many cases, it is. Hopefully, you find something that's not boring and also useful that you could use in the future. All right. So, first and foremost, if you are new to whole life insurance, what I am going to cover this evening is as follows. The point of interest with whole life insurance is never the life insurance of people we talk with, it's always the cash value and how to get as much cash value as possible. The cash value is your money. It's money you can access anytime. You can use it now, whether it be for a business, college education, maybe I want to buy a car or something like that. But it's money that I can access, and it's not just life insurance that's paid when I die. But then we'll talk about how you can use the policy. We'll go through an example of someone that really is using it for real estate, but it'll apply to any example. So let's start with some of the basics just on whole life insurance in terms of education. So here we've got a nice simple chart, and I just want you to focus on the three colors we've got here. So we've got blue, red, and green. Blue is the death benefit. You like that word, death benefit? Most people don't. So with a life insurance policy, why it's called a death benefit is there is a benefit paid out at our death. How a life insurance policy works is when you die, whoever you list as your beneficiary, which is the people that get money when you die, they get it 100% income tax free. So that's the case with all life insurance policies. Then in red, we've got what is called your premium and a PUA rider. We'll talk about that more in a little bit, but this is basically how you put money into a policy. And then we've got the piece everyone's interested in, the cash value. So with the cash value, what you'll see is that it will increase in value every single year. There's no risk, strong guarantees, and you can access it completely tax-free anytime you'd like. So to recap, what's attractive about the cash value? Grows safely. You can access it anytime while it keeps on compounding, and it's got a really, really nice tax benefit. So we're going to go through a basic example of how we should set a policy up. And when we get to Sasha's policy, you're going to see these same principles follow as far as how everything lines up. So typically, when we work with individuals or we set up a policy, what we're aiming to do is get as much cash value as possible. And we don't want the policy ever to feel like a burden. So simple case study, we're going to look at $10,000 per year going into a policy. And we're going to look at one product with one company, all with $10,000 per year going in. These are all going to be the exact same product, but you're going to see different results. All right. So option A, you ever see a life insurance illustration? If you're not Mike and Sasha, that's the question. Here's what it looks like. Stereo instructions, right? All these columns. I'll show you what to look at. So first, we've got the premium here, $10,000. This could be $1,000 per year, it could be $100,000, doesn't matter. So here we've got $10K going in. This person pays $10,000 per year for 10 years. After that, he pays nothing. There's his cash value. In the first year, he's got $300. He's paid in $10K for 10 years. That's 100 grand. By year 12, he's got his money back. Would you want that? No, I definitely would not want that. Then you've got option B. Look at this. There's that premium, $5,000. Remember that other term from that chart, that PUA rider? Another $5,000. 5 plus 5 is 10. Now all of a sudden, look at your cash value. It's not $300 bucks. It's $5,000. Get all of your money back by year 8. A little better, but not great. Here's a better option. Premium is less than $1,000. That PUA piece, we can just call that a cash dump in, is $9,000. You still pay a total of 10 per year for 10 years, But now you've got a lot more money up front. By the fourth year, you've paid in 10,000 times 4 years, 40 grand, which means you've got $40,000. That's when you get your money back, which is way better than 12 years like option A. So, which option got you your money back faster? All the same policy with all the same company, by the way. Option C. So, in the short term, in the first year, which one gives you more money? Option C. You paid in 10, you've got 8750. How about by the 10th year? Option C. You can see more in value. Year 20, option C. You see the trend here, right? 30 years down the road, I've got more money from start to finish. So
Here,
here's the key.
here's another question.
Good question. Why do people choose option A? If they know that other options exist and that option C has more money, why do people choose option A?
Excellent question. I liked how you asked it too, because you said if they know option C exists. So typically it's a lack of awareness. So a lot of times people don't know that it exists. And there's often not too much education around that. We're going to hit on the exact reason why something's going to scream at you in red. I'm going to pull it up in a minute, but you'll see the exact reason why that provides a lot of awareness just in terms of shopping for whole life insurance. Good question though. All right. So option C has the most money. Why? Because again, it's the same company, same product. He pays the same out of pocket, same to this person. Remember those two terms from that chart, that premium and that PUA rider? Here's how they work. Premium dollars in red. Number one, buy you life insurance. And number two, build cash value. Whereas that PUA, which stands for paid up additions, I like to call it a cash dump in, first gives you cash value, and then second gets you death benefit or life insurance. So last time going through options A, B, and C, A had everything going toward premium. B had half of our money going toward premium, the other half going toward PUAs. And C, we maxed it out. 1,000 toward premium was a little bit less than that actually, but everything toward PUAs. And we see a lot more cash value. So Sasha's question was, why would I ever do anything other than option C? Two reasons typically why. Lack of awareness, number one. Number two, it does have to do with the agent commission and insurance company profitability. Look at this. On the left, option A, this is what our company would make if we sold this product, but structured as option A, be $8,500 up front, and then over 10 years, we make more than 13 grand. Option B, cut in half. Up front, it's 4,400, commission. Over 10 years, 8,200. Option C, it's about $1,100, and then the total 10-year compensation is $4,200. So you can see the trend here. But what happens is if a policy is set up to give more cash value to the policyholder, the insurance company says, okay, we're giving the money to the policyholder, therefore we will not pay as much in agent commission. And that's how it works across the board. It's not just me or anything like that. But that's generally a driving factor as far as educating around the different types of policies. If that makes sense. All right. So lesson there, we want to minimize the premium, maximize that PUA rider, because that gives us more money as a policyholder. Also, here's a question that comes up. If you go with option C, do you get a bill for 10 grand every year? You do not. What we're billed for is the minimum premium, 1,000 per year. And then everything on top of it can be added at our discretion. So here's what most people do, and we'll stick with the same round number of 10K per year. If I want to fund 10,000 per year, I'll set it up where I only commit to $1,000 per year, and I can even pay that over 12 months. And the other 9K is optional. Now, if somebody said, all right, I like this, but I want to add a zero, what would that look like? If you said, I want to do 100K per year, well, now your minimum premium would be about 10K per year, and you can add another 90 at your discretion. See the trend? Typically, that minimum can be about 10% of whatever our total is. With the top companies, typically that 10% is the minimum. So a flexible policy lets us commit to a small amount. This way, it never feels like a burden, and we can add more money at our discretion. The policy looks a lot better. So again, there's your minimum premium, and then you can just plow more money into PUAs at discretion. You can pause there and see if anyone has questions, and then we can get into a quick loan example. All right. Want to see how you can use the money? This is fun because it's fun to put it in and watch it grow, but like, what if you want to use it for college, for example, right? So here we go. We're going to look at a demo with larger numbers, but it can apply to anyone. So here, someone's going to fund 100K per year for 5 years and take a loan of $300,000. And we're going to look at some numbers here. Here's his money going in, 100K per year for 5 years. By age 50, he's got more than 500K, 512,000, and there's your life insurance amount, 1.8 million. He doesn't pay anything in after that. What's his cash value when he's 59? 750. Remember, he stopped paying after 5 years in this example. His life insurance, 1.8 million. Okay. We're going to come back to this, but here's what we want to look at, the loans. So he's going to take a policy loan. Look at this guy right here, $300,000, because whatever you have in cash value, you can access through a policy loan, which you don't have to pay back, by the way, but it usually makes sense. So when he takes this loan out, here's what we want to look at. Year over year. By year 7, see what right here you earned $23,886 in green. That shows how much the insurance company paid you in interest in year 7. And what you paid them in interest in year 7 with that $300,000 loan outstanding was $15,000. So did you get more or did you pay them more? We got more, which is the name of the game. We want to make sure that that red number is not higher than the green. Otherwise, it doesn't make sense. If we look at the 15th year, you've earned a total of $288,000. So it's the total growth by year 15. And you've paid interest of 166. So we're making sure we have a positive spread here. So what we like to do whenever we're looking to use a policy is compare our policy with and without loans. So really, I want to look at the cash value growth and the loan interest cost, just like what we looked at there. So what we usually do with individuals is walk through exactly how a loan works. So here, in year 6, you've got that $300,000 loan. There's the impact of the cash value and the death benefit. Your cash value before you loaned, look to the left, 534. Now it's 219. What happened to your death benefit? Went down. By how much?
300K.
You got it. Anytime you take a loan from a life insurance policy, you will see the life insurance amount reduce dollar for dollar. Now, in this particular case, we're going to begin to repay it. And we'll just fast forward to the bottom. When it's paid, look at your cash value, 788 and change. What happened here when we compare it to the example to the far left?
It's the same.
You got it. So your cash value continues to compound or earn interest, even though you took the money out. So think of it this way: I'm earning 5% on 500K, and then I can take it out, use it to pay for college, use it to invest in a business, whatever it might be, but my money keeps on working for me all the way through. Now I've got those same slides again with a different scenario. I'm going to zip through these because it's a bit repetitive. These are different loan scenarios. But what we like to look at here is always anytime I pay a loan back, as I think it was Ephraim had mentioned, my cash value is always fully restored. And then we'll compare the cost to borrow with the loan interest, with the name of the game, maximizing my cash value all the way through. So here's a nice breakdown. Remember what we started with in the slides, the stereo instructions, we like to call them. So I'm going to go through a couple of versions of this. These are different variations that we looked at together. But here we see funding. I'm just going to first point to this. 80K per year. Now, the funding, Mike, I don't know if I'm allowed to brag or not, came from a full ride, correct? Scholarship funds. Okay, I can say that. Okay, good. It did. So funding came from a scholarship here, and Mike had reached out and discussed this with Sasha and then us as far as, hey, can we use this money to flow it through a life insurance policy? One, so it earns interest, but two, this money is going to be at work for her now forever. Because even if she decides to use it for school, whether it's during the first 4 years or if she goes back to college, perhaps, I don't know what your plans are in the future, but if you do take on further education, a cost does come with that, where now you've got this capital here that can be used for future education costs. But before we just jump into that, we've got the 80K per year going in. Remember option C, or like option A, B, and C? How do we know if this is like option C? Because this stuff is confusing. Like it seriously looks like stereo instructions. Look at all these columns, right? Here's where we can look.
Well, she paid only 7K, and the rest were all from a scholarship. If I get that right.
You're right there. Yeah. So I see what you're looking at with the 7K up here. So what that is, that's that minimum premium piece. Remember the premium or the PUA rider? The premium we've got there in red. Then there's that PUA rider, call it a cash dump-in, which is down here. Add those two together, there's the total of 80. So if this is you, do you get a bill for this every year? No. The bill is this guy up here. And then this is optional. This builds this. So if there's one column we want to focus on here, net cash value. That's your money column as far as what you actually have access to. So as we look at this guy, let's clean this up a bit. When you hear the word whole life insurance, naturally, how long do you think you have to pay premiums? I'll tell you what I used to think. My whole life, right? It's the name of the product. Not the case. So in this example, the out-of-pocket stops altogether after 4 years. We can scroll down, but there's literally zero going in after the 4th year. And the cash value continues to appreciate. So what I'll do here, pull up. So if you see the 80K per year in blue, we can see what the true minimum is. I just rounded up to 8K. It's a little bit less than that from the chart we just saw. But 8K, purple, is the cash addition, and then blue, 80K per year. Total outlay tallies up the total out of pocket we deposited. So 8 times 4 or 80 times 4, 320 grand. What's highlighted in yellow is the first year you get all of your money back. So here's something cool. You can tell you're talking to a real insurance nerd, right? When somebody says, here's something cool about a life insurance policy. Let's call this yearly growth and then total growth. What we'll look at here, let's make it different color. We'll go with dark blue with this one. What's the worst thing about this, right? Anytime you hear someone talk about something good, there's going to be a drawback, right? No matter what. So here's the drawback. First year, 80K goes in, $70,000 is in cash value. When we look at this, no matter how we spin it, this is option C, there's still a negative hit in the first year. Because I paid 80, I have 70, it's a loss here of $9,500. If we do the same thing the second year, there's a gain of $1,500. Here's where the gain came from. What we're going to look at, and we can use this with any type of account too, where I'm adding money on a regular basis. The first year, I'm at 70,501. I paid 80,000. If you had $70,501 under your mattress and you added $80,000 to your mattress, what would it be worth? Be a nice mattress. That'd be a mattress worth $150,501. However, when we look at the cash value, it's 152. So what that means is you got your 80K back that year, plus another $1,500 in change. So that's what that column represents, the yearly growth. It's showing how much we got from the insurance company net each year. We're backing out our payments. Because if I'm you and I have this policy, what I'm very interested in is knowing how much money did I actually get from the insurance company this year, because I don't want to include my money in that calculation, because that's my money that went in. So show me what I got from them, and then we can do that every year. Mike, I can send you this too, workbook with the formula. If you've got some folks in here that like Excel and see how all this works, I can definitely share this with you. So there we go. You can see what you're getting net every year from the company. And it's tax-free if we do it right. And total growth is easy. So this just looks at your total cash value minus your total payments. So now you can see with full transparency, when am I in the red, meaning the paid years are there? Am I comfortable with that? If so, then it can definitely make sense, but I want to see the drawbacks up front. Imagine if you get a policy because you hear about the long-term benefits and the upfront hits weren't, the upfront negative drawback was not made clear to you. That's where buyer's remorse comes up, like with anything, right? That's where people get upset. It's their money that we're talking about. But we see the year-to-year growth and then also the total growth. It's in the red until you see what's highlighted in yellow over here. The first year, your total cash value exceeds your total payments. Interesting stuff, right?